All right, let's get right into it. Something just went down in the silver market that, well, it left a lot of people scratching their heads. This wasn't some slow, predictable dip. No, this was a sudden, sharp move that just blew up the screens and had everyone asking what on earth just happened. And that's exactly what we're going to unpack here. And this quote, man, it just nails the feeling of that moment. 1 second, everything looks fine, almost kind of boring. The next, the floor just drops out. Liquidity vanishes. Poof, gone. This wasn't a gentle slide. It was a violent gap down. It was silver doing what it does best, reminding everyone that certainty in this market is, just an illusion. So the easy story, the one you hear floating around, is that, a bunch of nervous retail traders got spooked and just dumped everything. But when you really look at the details, that story starts to fall apart. This didn't feel like chaos. It felt calculated. And that's the real question we're digging into. What if the story we're being told isn't the real story at all?
To really get what's going on, you have to understand that there are basically two different silver markets. There's the paper market, the futures contracts, the ETFs, and then there's the physical market, the actual metal you can hold in your hand. And believe me, they are not always telling the same story.
And what you're seeing here is this huge disconnect. On the one hand, the paper price on your screen got hit. It softened up. But then you look at the physical market and the premiums. That's the extra cash you pay to get an actual coin or a bar. They stayed strong. So what does that tell you? It tells you that while the speculators were running for the exits, the serious buyers were quietly stepping in and buying up the physical metal on the cheap. The paper market was reacting to fear. The physical market was signaling real hardcore demand. See, when paper prices drop, but the demand for the real stuff holds firm, that's not just noise. That is a massive signal you can't afford to ignore. It suggests that the big, patient players, the smart money, are using all that paper volatility as a kind of smokescreen. They let the price on the screen fall so they can scoop up the actual metal more quietly. They're not scared of volatility. They're using it. And to understand why this split is so incredibly important, you need to get your head around this concept, the paper-to-physical ratio. It's actually pretty simple. It's just asking, for every 1 ounce of real, deliverable silver sitting in a vault somewhere, how many paper promises, how many claims are out there? This number is the key to all the tension in this market. And the scale of this? Well, it's just mind-boggling. It's not uncommon to see over 100 paper claims for every single ounce of physical silver. Think about that. The whole system works because most people are happy just trading the paper back and forth. But what happens if even a tiny fraction of those people suddenly say, you know what? I want the real thing. That's when the system gets put under a massive stress test. And this isn't theory. We've seen it before. Markets break when paper promises can't be met with physical reality. Okay, now let's add another huge layer to this. There's a buyer in the silver market that is so big and operates on such a different set of rules. A buyer that doesn't care about the day-to-day price swings because for them, demand is totally inflexible. So you really have two different types of demand here. You've got financial demand. That's investors, speculators. They can wait. They can try to time the market for a better price. But then you have industrial demand. And this is completely different. It's consumptive. It's driven by pure necessity. You can't just tell your multi-billion-dollar factory to stop production because you don't like the price of silver this week. It just doesn't work that way. And listen, we're not talking about small-time players. We're talking about solar panels, every piece of high-end electronics, critical medical equipment, defense systems, the whole green energy transition. These massive industries consume silver. They don't want it. They need it to operate. For them, silver isn't an investment. It's a critical raw material, period. This quote right here just says it all. When the paper price is getting slammed by financial worries, it eventually runs smack into this giant wall of industrial demand that cannot and will not bend. And when that happens, something has to give. And history tells us it is never the industrial users. They pay whatever price they have to because shutting down their entire operation would be infinitely more expensive.
So we have this insane amount of paper leverage on one side and this unbending industrial demand on the other. Now, let's talk about the supply. Because a crisis has been quietly building here for years, way before this recent price move.
You see, this didn't just happen overnight. For years, low silver prices meant nobody was investing in new mines. At the same time, the cost to pull it out of the ground just kept going up. So what happened? The available above-ground stockpiles have been slowly but surely shrinking. And now, even the existing producers are getting hesitant about expanding. The result is a slow, methodical squeeze on future supply, all while demand just refuses to back down. And here's the kicker about supply shortages in these complex modern markets. They don't start with a big headline. They start with these tiny little cracks. Things that are super easy to dismiss as just temporary quirks or, nothing burgers. But those little things, they're the real warning signs. These are the signals that tell you the ground is shifting. Delivery times start to stretch out just a little longer. The amount of metal sitting in exchange warehouses that's actually available for delivery just keeps drifting lower. And then you hear phrases like cash settlement preferred. That is market code for, hey, we'll give you the money, but we would really, really rather not give you the actual metal right now. And that is a huge red flag. It's like going to a grocery store for milk and they offer you a refund instead of the carton. It means the shelves are getting bare. So you put it all together, tightening supply, unyielding demand, a fragile paper market, it creates this incredibly tense situation. And yet, after a big move like the one we just saw, the market often gets quiet. And this brings us to the final and maybe the most critical point: why that calm is so incredibly deceptive. This metaphor is just perfect. After a shock, everyone kind of freezes. Buyers and sellers both hesitate, and the volume just dries up. And from the outside, it looks like things have stabilized, but it is not stability. It's tension. It's a massive amount of stored energy. It's a coiled spring just waiting for something to set it off. And that is the question you have to be asking yourself right now. We know how silver moves. It doesn't gently float higher. It snaps. It gaps up, leaving everyone staring at their screens, wondering how they missed it. And this gets to the absolute core of the argument, this idea of asymmetrical risk. Look, the downside pressure on the price, it's driven by stuff like fear and sentiment. It can be manipulated, it can be distorted. But the upside potential, that is anchored in physical necessity. It's anchored in those factories that have to get the metal. One of these forces can be delayed. The other is inevitable. And what we're seeing is this really deep psychological shift happening under the surface. The question in the market is quietly changing from how low can the price go to something way more fundamental. What if I can't get the metal at all when I need it? And when that fear of scarcity takes hold, well, that changes everything. It's a classic lesson from market history. The biggest, most profound shifts, they don't happen when everyone's watching and expecting it. They happen when the market is tired, when conviction is low, when everything just feels boring. That's when the foundation for a truly unforgettable move gets laid. At the end of the day, silver has this long, storied history of absolutely humiliating, overly confident predictions. It doesn't care about your charts or your bold forecasts. This market doesn't reward the loudest voice in the room, it rewards quiet, deliberate preparation. And that is what this whole thing boils down to. Right now, there's still choice. There's still time to think about this calmly and position yourself deliberately. But that window, that corridor of opportunity, it's narrowing. Once that hinge moves, once the market makes its real decision, that choice vanishes. And all you're left with is forced emotional reaction. And that is always, always expensive. So we'll end on this question. When you look at the split between paper and physical, when you see that industrial demand that just won't quit, and you see the supply quietly tightening, the current calm starts to look a lot less like stability and a lot more like the quiet before the storm. The choice is simple: preparation or reaction.